Okay, hello everybody. My name is Sean Raft. I'm the Chief Administrative Officer at Urban Catalyst. The purpose of this video is to walk our investors through their K-1s. All Urban Catalyst investors will receive an annual K-1. The document itself is not the most intuitive, so we thought it would be helpful for our investors if we had an expert walk them through the basics of the document. And what better person to do that than the guy who actually prepared them, our partner and friend from our CPA tax firm, Novogradac, Tom Bowman. Tom is an impressive guy. He's got 40 years of experience as a tax consultant with a variety of companies focusing on pass-through entities and has significant experience with new markets, tax credits, and opportunity zones. He worked for 17 years in public accounting, primarily with the big four firms. He, like me, is an attorney with a Juris Doctorate. He also has a Master of Business Taxation from the University of Minnesota, has served as an adjunct law instructor at the law school at Washington University in St. Louis, where he taught federal partnership taxation for 16 years. Tom is a partner in the St. Louis office of Novogradac, and Novogradac is an accounting firm with over 700 employees, 28 offices in several states. They work extensively with developers in the real estate industry, as well as investors and sponsors of opportunity zone entities. They are one of the 35 largest CPA firms in the country. Okay, so without further ado, let's get into it. Here's what we believe are the top 10 questions investors would like to know about their K-1. Tom, what is a Schedule K-1? What's its purpose?
So Sean, let's begin that discussion by talking about what the fund is as a business entity and what it does for federal tax filing purposes. The fund was formed as a limited liability company, which is called an LLC for short. And an LLC is a business entity that has members who are not liable for company debts. Their total exposure as a member is the cash that they paid for their membership in units. And LLCs file a tax return as a partnership, and LLCs and partnerships do not pay federal income tax. Instead, they pass through their income and losses to their members who report their share of the LLC activity on their individual income tax returns. The LLC itself must file Form 1065, which is the U.S. partnership return of income, and that return has to be filed for each calendar 12-month period. The return is due to the IRS on March 15th following the calendar year, but the fund can extend it for another 6 months and file it as late as September 15th. Attached to the annual tax return is a Schedule K-1 for each member, and that's the Schedule K-1 for each member reports their share of the LLC's activity for the year. Let me give you an example of how that might work. So let's say the fund earns $100,000 of net income for 2020, and that would be all income minus all expenses. And let's say it has 10 individual members that each own exactly 10% of the units. So each member would report 10% of 100,000 or $10,000 on their K-1 that they receive from the fund. And then they would use that $10,000 and report it on their individual tax return to the IRS. The fund may have to file a state return as well, and also in more than one state, depending upon where it actually conducts business. It'll have to file in whatever state it has real estate that it's developing and operating. Right now, that's limited to California. It also potentially has to file tax returns where its employees live and work. And one of the issues with state returns is if a LLC files in more than one state, some of the states have different rules on how to determine income or losses sourced to that particular state. So sometimes when you add up all of the state income, you get a different number than what's reported on the federal income tax return.
Tom, one of the questions we get a lot, is logistical. Investors want to know, when is my K-1 going to be available for review, and how do I access it?
Sure. Well, NES, I think, is the investors know is the fund administrator, and they keep custody of the fund accounts. They provide numbers along with the fund bookkeeper, Bengali, to my firm, Novogradac, so that we can do the audit and tax work. NES does not actually prepare the K-1s. Novogradac does that, but they will provide the K-1s to the investors through their investor portal once they receive the K-1s from Novogradac. And NES will send out an email notification to each member with a link to their portal. And you can access your K-1 through the NES investor portal. And that access should be provided to you when you've completed your onboarding process.
One of the questions we get a lot from our investors is when exactly they can expect to receive their K-1 when they're preparing their taxes, especially with the tax deadlines looming.
And the answer to that is the goal is for the fund to issue their K-1s to their investors as soon after a year as is possible. However, we are limited to first having the financial statements completed, and that takes some bit of time before they're actually done. And it's a multi-step process where the financial statements are done, and then the tax preparers take over and start with the audited financial statements and then prepare the return. The goal is to get it to you as soon as we possibly can to provide you with enough time to do your individual tax return, ideally before April 15th. But if not before April 15th, then soon after April 15th as is possible. And if it is delayed until after April 15th, then the investors will have to extend their individual tax return with the IRS and file their individual return once they get their K-1 after April 15th.
Right, and Tom, we can't get the tax returns prepared until after the audits are complete, right? That's the natural workflow, and the audits take a lot of time, right? Because everything is being done very carefully. So, is that part of the limiting factor in terms of delivery?
It is. It is, Sean. The auditors want to make sure that they've identified all of the important information that's reflected in the audited financial statements, and so they don't want to short circuit the process and then have to change it after the fact. So they want to be careful and deliberate about exactly how they do that and make sure the information is going to be accurate and also not change after the fact.
Yeah, that's great. That's great. Okay, so now let's fast forward and let's assume investors have their K-1s. And so now the investor may be thinking, well, what do I do with this thing? What do they do with it?
So it depends, first of all, whether they prepare their tax return themselves or they use a tax return professional. I would encourage people, particularly when they get a K-1 and they don't know what to do with it or haven't seen one before, to engage a competent tax preparer to prepare their individual tax return. But what you have to do is take that K-1 and reflect it in the proper forms that are attached to your Form 1040. And if you fail to do that, it can result in penalties and interest assessed by the IRS. And the important thing to note is that the IRS will trace the numbers on your K-1 to your Form 1040. So if you don't report the information on your 1040, you're likely to get a notice from the IRS. And that's happened for many of my clients. And then you need to respond to that notice. And if you actually haven't reported the information, then you do risk having penalties and interest charged by the IRS. Now, the states aren't quite as sophisticated sometimes as the IRS is in tracing information to a state return. But I do know that California is particularly good at doing that. So for those of you who will be filing California returns, I would encourage you to make sure you reflect it properly in your California return and also use a competent professional to help prepare your return for you.
I'm glad you said that, Tom. Investors who have spoken with me have heard me say many times that they need to rely on the advice of their tax and legal professionals. So I'm glad they're hearing it from someone else. And I think the bottom line here is that it's very important to include this information in your tax return. It's mandatory. And if you're not going to do it yourself, you should make friends with a CPA and make sure you give all that to them. So that's excellent. Okay. Now, from a high level perspective, I want to ask you, what is it that from an investor's, when they're looking at the K-1, what can they expect to see in the document from a high level?
Well, the most important line on the K-1 for the investors in the fund will be line 2, which is income and loss from rental real estate activities. And the important thing about that is that first, how is it calculated? It's the rental income charged by the fund to the tenants that are occupying the real estate that the fund owns, less operating expenses, which would include a mortgage interest as well as depreciation. Now, depreciation is a non-cash expense. So although it decreases taxable income, it doesn't decrease available cash. And one of the things that people have to recognize is that there's special limits that apply, particularly on rental real estate losses, as to whether they're deductible or not on your individual return. The rental real estate losses are typically subject to the passive activity rules, which are a very complex set of rules that were added quite a few years ago with the goal of limiting the ability of investors to invest in tax motivated transactions that are generating tax losses without real economics. That's not an issue with this structure, but the same rules do affect the ability of the owners to actually deduct the losses if there are losses on their K-1s. And typically in the early years of operating real estate, the line 2 rental activity is going to be a loss instead of income. It's just, it takes a while for the property to stabilize with a tenant base and to produce operating profits on an ongoing basis. So it's usually a few years down the road before you'll start seeing taxable income on line 2 of your K-1.
Yeah, this is a good point. And it's something that we've referred to as the J curve, which we're not going to address here today, but we do have, other information on the J curve that investors might want to check out. But, we're talking about losses here today. And I think ordinarily that might raise a red flag in an investor's mind. Losses, shouldn't we be talking about gains? But losses being a natural part of the life cycle of the fund, as we briefly discussed already, are losses, Tom, generally a good thing or a bad thing?
Well, in this context, they're generally a good thing because the losses don't reflect a permanent decrease in the value of the asset. They just reflect the excess of expenses over income that typically occur in almost every real estate project in the early years of operations. And the issue for the investors, can they actually deduct that loss on their tax return? That's a more complicated question because, as I said in the previous answer, the losses are typically subject to the passive activity rules. And basically what those rules say is that if you are passive in your investment, meaning that you're not an active real estate professional, which most of the investors are not going to be satisfying those rules, particularly with respect to this particular investment, then they can only deduct the losses from line 2 against other income they have from other sources that is passive income, which would include rental income from other investments that they have. So these rules prohibit you from taking the rental loss if you're passive and offsetting, for example, wages or interest income or dividend income or capital gains. So it's rather restrictive, which if the losses are not deductible under these rules, you can carry the losses forward to future years until you either generate passive income from other investments or from this investment, or when the investment is disposed of, then the suspended passive losses are fully deductible.
So it sounds to me like the highlight here that investors may want to take away is that passive losses can be a very good thing for them to the extent they have the ability to offset other passive income, whether it's from passive income in this fund or other investments in their portfolio. Is that a fair statement?
That is a fair statement.
Okay. And so, but it also sounds, and I'm going to come back to a line that I like to say a lot, and I'm glad you already said it. You hit it first before me, Tom, which is some of this stuff can get very technical and very complicated very quickly. So the bottom line is for investors to be aware of this generally, but to talk more specifically with their CPA because it is technical and might be challenging to unwrap.
Yeah, I think it would be wise for anyone who makes an investment in the fund to have a professional prepare their individual tax return. And, they can go to many different firms. Some are very low cost, like the H&R Blocks of the world. But there are alternatives out there from low cost providers that are surely capable of doing it right to a much more expensive firms. But the key is just to get good tax advice.
All right, so Tom, now taking another step back, our investors have this document in their hands and they're looking at it and they're probably thinking, why in the world are there so many boxes? What are all these boxes about? Can you help explain some of that?
Yes, and all these different boxes just illustrate the fact that the federal income tax is very, very complex. And that's why there are so many different boxes on the K-1. And the separation of the boxes is intended to either give the investors some information they need to prepare their tax return, or to classify and characterize income into different types, because the different types of income may have a special tax rate that applies. For example, dividend income and capital gains are separate boxes on the K-1. And that type of income is subject to a maximum federal income tax rate of only 20%, compared to the highest rate for other types of income caps out at 37%. So all of these different rows and boxes on the K-1 are designed to identify and implement certain characteristics or rules that have to be followed in order to properly prepare your individual income tax return. And your tax return preparer will know what to do with them.
All right. Well, Tom, thanks for explaining, why there's so many boxes on the K-1. But can you explain more specifically what those different boxes are?
Yes. So let's start with part one, which is the upper left side of the K-1. That is the information about the fund, the name of the fund's address, and where it files its tax return with the Internal Revenue Service. Then moving down below that is part two, and boxes E, F, and G indicate who is the member, what is their social security number or tax ID number, what is their address, and what type of member are they? Are they a manager member or a non-manager member? In addition, box H1 indicates whether the individual or a member is a domestic person, meaning someone who lives and resides in the United States, or is a foreign individual. And box H2 will identify if the owner owns their interest through a disregarded entity, like a wholly owned LLC. That's just for informational purposes only. Typically, those disregarded entities are ignored for federal tax purposes, but many owners actually do use a disregarded entity to own their equity in a fund. That's fairly common. Box I2 indicates whether the ownership is through any type of retirement plan, which generally won't apply to anyone that's involved in the fund. Box J is the share at the beginning and end of the year of the members' profits, loss, and capital ratios. And those are simply determined by taking the ratio of the total contributions that a member contributes to the fund divided by the member contributions of all members. box K is the member share of liabilities, and at the during earlier question, I emphasized that the liabilities that show up on the K-1 are not liabilities that the members are liable for in their personal capacity. These are just for information purposes only. They're categorized into three different lines, which is non-recourse liabilities, qualified non-recourse liabilities, and recourse liabilities. It's very unlikely that any of the members will have recourse debt reported on their K-1, but they might have non-recourse and qualified non-recourse financing. And the reason that information is presented is because a member's share of the fund's debts give them tax basis. And tax basis is a good thing because it allows the member to deduct more losses and also to take out cash distributions that are tax deferred. Those are very complicated calculations, so you have to rely on your tax return professional to help you figure out what that all means. But the reason for the debt disclosure is simply for a basis calculation, as well as an at-risk calculation. And the background on this is that a member can never deduct more losses from the fund than their basis and their at-risk amount. And those are separate calculations. And your basis is the sum of all of the debt that's on your K-1 at the end of the year, plus your ending capital account that's in box L. And that sum always has to be a positive number. And that net positive number represents the total, your total basis, and that number can never be negative. And if distributions that you receive in the form of cash exceed that's the summation of your debt and the negative in the capital account, then the excess would be capital gain distribution to you.
Tom, before we talk any further about that, I wanted to come back to basis for a moment. You've highlighted its importance, but it's really important here. As you indicated, you need basis in order to utilize passive loss to offset passive income. You need basis to be able to take distributions in the form of return of capital, tax-free, et cetera, correct?
Correct.
But by operation of law, in the opportunity zone rules, subdivision B2B states that immediately when an investor makes an investment into an opportunity zone fund, their tax basis becomes zero. It starts at zero.
That's right.
But there are ways to step up the basis, right, through basis debt allocations during financing events, et cetera.
That is correct as well. So, so the and the way this will be reflected on the Schedule L, which is the partner's capital account roll forward, is in the year they make their capital contribution, the second line on Schedule L, which is capital contributed during the year, will be a positive number. So let's say they put $100,000 of deferred gain into the fund as a capital contribution, namely the payment for their membership units. That'll show up on row 2 of Schedule L, the box called capital contributed during the year. And then down below, 2 rows below that, for other increases or decreases, that same amount will be subtracted out because there is no tax basis for that number because of the fact that it represents gain that was deferred and won't be taxed until later. And then and that number will go back up in 2 scenarios. One when you get the 10% or 5% basis boost, which occurs in year 5 or year 7, if those years occur before 12/31/26. And the example of that is if you put in $100,000 as your deferred gain as a capital contribution, your initial basis is 0, even though you put 100,000 in. If you hold your equity for 5 years prior to 12/31/26, then on that 5-year anniversary, you get a 10% basis boost, and your basis goes from 0 to my example of using 100,000. your basis would go from 0 to $10,000. And then if you hold your equity for 7 years prior to 12/31/26, you get another 5% basis boost. And using my numbers, your basis would increase by another 5,000. And those adjustments will appear as other increase or decreases when and if you hold your equity for the 5 or 7 year period prior to 12/31/26. And then on 12/31/26, whatever remaining gain hasn't been taxed yet of your deferred gain would be taxable on 12/31/26. And that remaining amount would show as an increasing your basis back up, in this case, using my numbers, to the original $100,000 that you deferred in the year that you made that you bought your units.
And in addition to that, oh, I'm
Yeah.
sorry, you're probably going to hit it, right?
I was going to say one more thing, that there's 3 limitations that a member has to apply to their tax return each year to determine whether any losses that are on line 2 of their K-1, which is the rental losses, to determine whether they're actually deductible. One is they have to apply the passive activity rules, which means that if they're passive, and that means they're not actively involved in the management of the company, then they can only deduct the losses on line 2, which are the rental losses, against other passive income that they have from other investments that they have. And remember, interest, dividends, and capital gains are not passive income, so you can't offset passive losses against interest, dividends, and capital gains. But there's 2 other limitations they have to apply, and that's basis and at risk. The basis limit I summarized briefly before, which basically says that you cannot deduct losses from the partnership that decrease your basis below 0. and that will be that you won't have a problem with that, as long as all of the debt that's on your K-1 on box K, regardless of the 3 rows that it's on, when you add those up, and assuming your capital account is negative at the end of the year in box L, as long as the debt exceeds the negative capital account, you still have a positive basis, and you haven't violated the rule on exceeding losses deducting losses that exceed your basis. And then the last rule is there's an at-risk rule that says you can only deduct losses to the extent you're at risk. And the at-risk rule is very similar to the basis rule, except that instead of including non-recourse debt and just non-recourse debt in your at-risk basis, you can only include qualified non-recourse debt and recourse debt in your at-risk basis. And so your at-risk basis is always going to be lower or equal to your regular basis. And you have to apply all 3 of these limitations: the passive rule, the regular basis limitation, and the alternative at-risk basis limitation every year to figure out whether your losses are in fact fully deductible, which is a good reason why you need a competent tax return professional to help you prepare your return to figure all of that out.
Yeah, thank you for saying that again. We can't stress that enough. It's also one of our written disclosures on almost all of our material. But yeah, it's important to have a tax professional help you navigate these waters. But you talked about the step up in basis, statutory step up in basis with the 10%, paying your taxes when they're due after the deferral period ends in 2026. But there's also other ways to step up the basis, correct? So for example, if the fund is taking on financing events, then the fund can allocate a portion of that debt to the investor to step up their basis prior to or separately from any of those other events. Is that correct?
That is correct. So as the fund acquires more property and uses some leverage financing to acquire those properties, then that additional debt will be allocated to the members and give them additional basis.
And then to the extent that there's any unused passive loss in their capital account, the tax rules allow the investor to carry that unused passive loss forward to the next year, or until such time at which they can actually use it. Is that correct?
That's correct. So, and they'll be able to use it either in years in which they have passive income from another investment or from the fund itself, or when they sell their equity in the fund. And the earlier of those events to happen, their unused passive losses will be fully deductible.
Right. And then a couple points with that. First, not to put you on the spot, but is there a code section that we can cite to that talks about the suspension of loss or the ability to carry forward unused passive loss into future years?
Yeah, it's section 469 of the code. That's the statute that deals with the passive activity limits.
And then this is one of my favorite sections, 469 G1A, which talks about the conversion of passive loss into active loss upon liquidation of the portfolio in the fund, correct? Can you
That's
talk
correct.
about that a little?
Yeah, so this is all a timing difference. The purpose of this statute was to defer the deduction of losses that Congress viewed were paper losses rather than true economic losses. And so the idea was that you wouldn't know your true economic loss until you actually sold your investment. And therefore, if you are unable to deduct the losses in the intervening years because you are passive, then by the time you sell your equity, you will know your true economic loss. And in fact, if you have a true economic loss at that point in time, then the loss is typically fully deductible.
It's fascinating stuff, Tom. I love it. So, okay, excellent job. Thank you very much. What other boxes on the K-1 are likely to apply to our investors?
Well, let's talk about box L and how it's calculated, which is the partner's capital account roll forward. So
Yes.
I view a capital account, and I taught partnership tax for 16 years. So when I was explaining this to my students, I would equate it to a bank account with a bank. So what is your capital account? Well, just like with a bank account, you open up the account, you make a deposit to it. That increases your bank account balance. Well, when you make a capital contribution to a fund taxed as an LLC, then your capital account goes up by the amount of cash that you contribute to the fund. Now, in this particular case, the fund is getting money that's tax deferred, so that opening cost basis of that cash is zero. That's just unique to opportunity zones. So what happens going forward then, just like with a bank account where when you get interest earned on your bank account, that increases your bank account balance. Well, when you get income allocated to you from a LLC, namely the fund, your capital account goes up as well. And just like with a bank account, and if you have charges like some kind of an expense that the bank charges you, your bank account goes down. Well, with losses and expenses incurred by the fund, then your capital account is decreased as well. And the final analogy is when you take money out of your bank account, a withdrawal, your bank account balance is decreased. Similarly, when the fund makes cash distributions to you, your capital account goes down as well. At the end of the day, when your capital account is liquidated and you're no longer a member, your capital account will go down to zero, just like when you close out your bank account will go down to zero.
And just as a reminder, what we're talking about with respect to the capital account on the K-1 is the tax basis, capital account balance for the investors. And once again, I think that's fairly complicated, right, Tom? And they should probably be using a CPA to help them with that as well, correct?
That is right. And if most likely the fund will be using a different method on its financial statements to reflect the capital accounts. And so if the investors are looking at the financial statements, they'll see a different capital account balances. And that's because more often than not, there's two reasons for that. One is the rules for how income and expenses are reported for income for financial statement purposes might be different than how they're recorded for tax purposes. And those are usually just timing differences in terms of what years the income and expense are reported. So because of that, the financial statement capital accounts at the end of any particular year might be different than the capital accounts on a tax basis. In addition, they might mark the assets to fair market value on the financial statements to reflect unrealized gains and losses in the assets. And that's not done for tax purposes. The unrealized values and losses in the assets aren't recognized for tax until the asset is actually sold for money. So there could be a difference in the financial statement capital accounts and the tax capital accounts because of differences like that.
Right. That's all important to know. Thanks, Tom. Any other boxes that
Yeah,
you
so
think are
let's go over some of the boxes in part 3, which is the partner share of current year income deductions, credits, and other items. So, and let's just go over the ones that are more likely to apply to the investors in the fund. The first one, which we talked about before, is line 2, which is net rental real estate income or loss. So this will be the net income or loss that the fund reports from the operations of the buildings after they're placed in service. And as said earlier, in the early years of a operation of a building, those are likely to be losses. And then later years, in the outlier years, they generally turn profitable. And so expect to see losses on line 2 during your few initial years as a member in the fund. The other line you might see is interest income, which is box 5. And that's interest on temporary investments that the fund makes. So it may have some idle cash that it puts into a bank account, and there might be some interest income earned on those funds. And if there is, your share of it will be reported on box 5. That number then goes on Schedule A of your individual Form 1040, which is interest income. And so that's how you report it. If the fund ever sells any of its assets, it'll show gains and losses on the sale of those assets in potentially three different boxes, which is box 8, net short-term gains and losses. It's unlikely that they would sell anything to be a short-term gain because that's selling an asset having held it for less than a year. So it's unlikely the fund would ever do that. There could be some long-term gains and losses, though, reported on line 9A. That's a gain or a loss on any asset held for more than a year. And then box 10 is 1231 gains and losses. And that's basically some gain, and also line 9C, which is section 1250 gain. Those are just characterizing some of the gains as ordinary income, or alternatively gains from the sale of business assets that are still capital gains, but they're sale of business assets, or it reflects depreciation that was taken in the past. So effectively, the cost of the asset has gone down from depreciation, and if the sales price is above the cost of the asset net of the depreciation, then some of the gain is taxable at higher than 20%, but a maximum rate of 25%. And that's called the section 1250 gain, and that's line 9C on your K-1. So when assets are disposed of by the fund, you'll see boxes 9C, 9A, 9C, and 10 being populated.
Now, with respect to depreciation recapture, which we've alluded to, assuming that the fund liquidates real estate assets after the 10-year hold and the step up in basis to fair market value happens, isn't it true that the regulations, it's section 1400Z2C1 B22A, indicate that there should be no recapture of depreciation from a tax perspective for the liquidation of those assets?
Yeah, that's true, and that's a good point. That occurs if the assets are sold after year 10. So if there's a sale of the assets after holding the investment, the membership units for 10 years, then the gains basically are not taxable. And so if that was the case, then these boxes that I'm talking about would probably be 0. We're not quite sure how to report that yet, because whether we have to report the numbers and then have some other information indicating that it's not taxable, or if we just don't report them at all because in fact they're not taxable. So we'll have to figure that out once that happens. But the important point and the real benefit of these opportunity zone investments is that gains triggered by sale of assets after 10 years are not taxable. And that's basically unheard of in the Internal Revenue Code, that kind of result. And it's special and unique to the opportunity zone rules. Outside of the opportunity zone rules, there are very, very few situations where you can get any kind of benefit like that. So
very well said.
That is an important point to make, that there may actually be no actual gain that's taxable after year 10.
That's wonderful. Thank you for saying it so clearly, Tom. Are there any other boxes you want to make note of?
Well, there's just a few. Line 13 is other deductions. There's probably going to be some expenses that the fund has that, particularly at the fund level, where there's some administrative expenses that end up on that line, and so you'll have to talk to your tax return preparer about where to put those. But you can expect to see some small numbers in that line. And then you're likely to see in some outlier years some distributions on box 19. That'll be cash that's being paid to you from the fund. And typically that's tax deferred until the total distributions, they're first a return of capital and then their capital gain to the extent they exceed your tax basis. As indicated before, your tax basis is the sum of all of your debt on the K-1 plus your end of your capital account. And you should talk to your tax advisor when you get distributions just to make sure that they're handled correctly on your individual return.
Right.
So the other box, Sean, that the investors should look at is box 20, and particularly subcode Z. And this will be labeled as the amount of qualified business income that they have for the year, and that might be a loss. And it should match their number on box 2 of the K-1, which is the rental real estate income or loss. And it, particularly if it's income, the benefit of that box is it's subject to a maximum rate of 29.6%, because there's effectively a 20% deduction that applies to it. And this is a calculation where they definitely need to talk to a tax return professional in order to get it right, because there's very complex rules that apply to this. But it's important because it's a potential to minimize their tax liability if line 2 rental income is actually positive.
Some of our investors may notice that they're receiving K-1s from multiple states, such as New York. Can you explain why that's happening?
Yes. So first of all, the fund has to file a state return in every state where it actually has real estate operations. Right now, that's limited to California. And so if an investor lives in Louisiana, they're going to have to file a California return to report their share of income or loss on a California return. And if it's a loss, they should still file in California, because even though they may not pay tax for the year of the loss, they may be able to carry that loss forward and offset income in the future when the K-1 turns the losses into income. In addition, you might add a property in other states in the future. And when that happens, the fund will start filing in states where it adds additional real estate assets. And lastly, some states require a return to be filed if a member of the fund lives in that state. That K-1 should only go to members who actually live in the state, and New York is one of those states that requires a return to be filed if the fund has New York residents, and New York residents should get a New York K-1 in that situation. Or if a K-1 is given to you from New York and it's and you're not a New York resident, that K-1 can basically be ignored unless the fund actually has New York operations, which right now it does not.
So Tom, if I'm a New York investor and I'm receiving a New York K-1 in addition to the ordinary federal K-1, am I going to be, should I anticipate having any tax liability to New York?
Well, if you're getting a New York K-1, it means you live in New York. You're a New York resident. There's a New York address on your K-1. So obviously, you're going to file a federal return and report the fund activity on your federal return, and you're going to report the fund activity on your New York return as well. Now, you're also going to have to file a California return. And if the California activity from the fund in a particular year is income, then you're going to pay California income. And then if you live in a state like New York that also has an income tax, you'll get a credit in New York for the tax you pay in California. Now, there can be limits on how much of a credit you get for the California income tax you pay, because the California income tax rates are one of the highest in the state, in the United States. So all the states that allow a credit for taxes paid to other states for the residents do limit the amount of credit that you can take for the other state taxes.
Great, but the important part here is that investors aren't going to have to pay taxes twice on the same
No,
income.
typically there's tax relief through a mechanism of taking a credit. Effectively, what happens is they end up paying an effective state income tax rate of the highest rate for the state where the property is located or the state where they live. So, for example, if California is 13% and New York, let's say, is 11%, they'll end up with a total state tax liability for income relative to just the fund's income of the highest of the two rates, which would be 13%. It wouldn't be 13 plus 11. It would just be the highest of the two. That's the effective cost of having operations in a state where you don't live.
Yeah, so it's very complicated. So do the states adopt the same kinds of complicated rules that are included in the federal income tax law as well?
Some do and some don't. First of all, there's a handful of states that do not have an income tax. And I'm sure the people who are going to watch this video know if they live in that state. Those are states like Washington, Texas, Florida have no income tax. And there's one or two states that only tax certain types of income. The vast majority of states have an income tax, but their rules do vary. For example, some of them adopt the federal tax law current with any changes to the code as adopted by Congress. So as the federal tax law changes, the state law changes accordingly. Other states like California only adopt the federal tax law as of a specific date. In California's case, it's 2015. So any changes to the federal tax law after 2015 are not automatically modified for California purposes. And that doesn't mean California can't do specific add-on changes to their law, and they do that periodically. But there's quite a few differences in California tax law versus federal tax law. So you have to understand what states you live in and what the rules are in that state. And that's why your tax return preparer can help you figure that out.
Now, you mentioned this already, but I'd like to highlight it again. Do non-resident investors in our fund need to file California returns because of the K-1 that they're receiving with our assets located in California?
If they're not already filing a California return, then they should file, even if there's losses reported on line 2, because if there are losses reported on line 2, they won't pay any California tax for the year in which the losses are generated, but they might be able to carry that loss forward to a future year and offset income in a future year from the fund. So it would be prudent for them to file a California tax return every year to report the activity that's reported on their California K-1 that they get. And the fund will issue them a separate California K-1 that incorporates any changes that California law has compared to the federal tax law.
Okay, good. Now, I'm sure this is not going to happen. There's probably a 99.9% chance that this question may be irrelevant for our investors. But just in case, what should our investors do if they notice that their K-1 has an error in it?
That's a good question. The most likely error is going to be an error in the federal tax ID number or address of the investor. And so if that's the case, you should bring it to the attention of the fund administrator, NES, or to the fund manager, Urban Catalyst, and let them know of the error. And at a minimum, the error will be fixed for the next tax return. The fund will have to decide whether it should change the filing that it made with the IRS or the states to correct that error. If it's a more significant error, like you think the income or loss to you for some reason is wrong, you should bring it to the attention of NES or the fund manager as well. But the changing the taxable income of the fund is quite a bit more involved and complex, particularly because the Congress changed the rules on amending partnership returns back in 2017 for years 2018 forward. So it's quite a cumbersome process to actually change a partnership tax return and report the information to the partners. But those errors are unlikely to happen. It's more likely just an error in your address or the federal ID number of the member.
Right, and in those more complicated examples, obviously, our investors should consult with their tax professionals.
The one thing I would emphasize is it's important that you report what's on your K-1 as the numbers on your individual return, because if you don't, you expose yourself to penalties.
Right, right. Good point.
And
okay,
there is if you disagree with it, you can always use a different number, but you're supposed to do a special form and add it to your return to report the fact that you're not reporting the amounts on your K-1 on your tax return. And if you don't do that, you risk the penalties. And if you do that, you risk an audit, because the IRS is likely to audit a tax return that attaches the form that says that the amounts reported on that individual return are different than the amounts that were reported to them from a partner in which they're a partnership in which they're an investor.
Right, and I'm sure we all want to avoid that.
Yeah, no one likes an IRS audit.
No, except for maybe Tom.
Well, the IRS likes it, I suppose. I don't know.
Okay, so Tom, let's assume I'm a first-year investor. This is the first time I've invested in something like this. This is my first time I've invested in an opportunity zone fund, and this is the first year that I'm filing taxes. What forms do I need to be aware of, with respect for my filing for for that tax year?
So the first thing that you'll need to know is that you'll have a receipt of funds letter that you'll receive when you deposit your investment. It's emailed to investors by Urban Catalyst. Starting with after the end of the first year of your investment and all other years, you'll receive your annual federal and state K-1 forms sometime after each year end. We talked about the timing earlier during the discussion, ideally as early in the year as possible. And then you'll need to incorporate that K-1 information in your federal and state tax returns. You'll get these K-1s every year in which you own your equity in the fund.
Right, and I would just add that investors would need to work with their CPAs. They're also responsible for adding a couple forms to their own filings. I believe those forms are Form 8949 and 8997, but they should consult definitely with their tax and legal professionals while preparing their returns, regardless.
Yeah, a competent tax return preparer will know what forms have to go into the return.
Right. Well, Tom, I want to thank you very much for taking the time to educate us here today about all the differences and the nuances with respect to the tax laws and the Form K-1. I think you've helped us out a lot. You've helped our investors out a lot. This was great. So thanks very much.
You're welcome.